Well, what was awesome about it was the questions you were asking me, and I know it was all for a big blog post of yours. You were really stretching my thinking, and I love when people set my mind alight. And once that fire gets roaring, I couldn't help myself. I'd be sitting at the keyboard, kind of tapping away. So you really energized me, and I love your energy, and I'm delighted to be here with you today.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Chris Douvos is the managing partner of Ahoy Capital, and he boasts an incredible portfolio of having invested in First Round, True Ventures, Data Collective, Rhapsody, and the House Fund, which personally, given my Berkeley background, I'm partial to. You are also the person who taught me the term, and you've seen, like, I think even prior to you teaching me this term, you've shared it quite a bit, but moolah in the kula. And he also writes this great blog with the same first name as this podcast, Super LP, which is some of the best evergreen content you'll ever find on thinking like an LP and evergreen frameworks and on a fundamental level. So absolutely love it. Prior to Ahoy, he spent 7 years at VIA, and this is going to be the first of two abbreviations to come, Venture Investment Associates, as the managing director, putting 10 figures worth of capital into the private equity and venture world. Prior to that, he led private equity investing at TIFF, the investment fund for foundations, and needless to say, Chris, you are well networked in the space. And this is something I've actually noticed in doing homework with this. And we mentioned a little bit of this in the pre-chat, but you are extremely well read because every single podcast appearance you're on, you're probably spitting out like 4 to 8 quotes per podcast appearance, citing anyone from Yogi Bear to Herodotus to Henry McCants, and at least one great quotable anecdote in every single blog post you've written. And you have a profound knack for impressions, which this might be a promise to the audience. I'll do a very light promise to the audience. You are really good at impressions, and which makes the former tons more interesting to listen to. I don't know if the latter is intentional, but we might get into this. But outside of the world of venture, you are a little league baseball coach and an expert in timber. So, Chris, welcome.
Thank you so much for having me. It's great to chat with you.
I think this is our first live conversation as well. We've had a lot of asynchronous conversation, which I've just like loved. And it's so hard for people to have so much energy in pure text. And you have it, and I love it. So I was like, when I started this podcast, I was like, I've got to get Chris on. No matter what I do, I'm going to go hunt him down. I'm going to get Chris on. So I'm excited, and the audience is going to know exactly why. But there's a million places we could start off in. But I want to start off somewhere that might be a bit more interesting. Which is this might go back chronologically into time, but you let me know which chapter of your life you want to pick from. So James Clear, who's a phenomenal mind, has this great line where he says, almost every idea you have is downstream of what you consume. And between the two of us, that may just mean brick oven pizzas. But I'm curious, from your time at Princeton to TIFF to VIA to Ahoy, is there a chapter of your life or career that disproportionately shaped your ethos as an investor in venture funds?
When I was at Princeton's Endowment in the early O's, it was an unbelievable time, not because venture was, rocking and rolling, but quite the opposite. We were in the teeth of the dot-com bust, and it was just an amazing time to learn the craft of venture from some of the, kind of great practitioners. And, being at Princeton, we had such a great portfolio, and I found myself randomly in the venture seat and getting a chance to go and to these annual meetings, to Sequoia, to Greylock, to others, where a lot of people had given up on venture, and it was really out of favor asset class. That's hard for a lot of people to understand today, but there was a time when nobody wanted to touch venture. And hearing from people what had gone wrong and what had gone right, and that's you talk about kind of formative experiences. One of the things that I learned during that period was from Henry McCants, whom you mentioned earlier, the one of the founders of Greylock. And he said something to me. He said, "Son, when venture works well, capital is expensive and time is cheap. When that relationship gets reversed, watch out." And that was like one of the most, kind of profound things anybody ever said to me. And what he meant, capital should always be expensive. In venture, we buy the longest dated, furthest out of the money option. And there should be a compensation for that, right? Like people don't invest, from altruism or to do cool gee whiz stuff. Maybe some people do. So capital has to be expensive. You have to earn a meaningful risk premium for the illiquidity and additional risks that you take on. Um, but at the same time, what he meant by the, time is cheap part is that, and this really jived with, I took David Swenson's class in college and again in business school. And Swenson talked a lot about venture being a catalytic asset class where a great venture investor can really engage with, with portfolio companies and create connections. Not the way everybody does it, but there were definitely some venture capitalists kind of throughout my career that really helped, kind of kink the trajectory of, their portfolio companies upwards, either by making the right connection at the right time or, engaging on developing, product or product market fit or go to market strategy or, or by helping set the company's DNA as an engaged partner, and that kind of luxury of time is not something that we tend to have much in venture because everything's moving at startup speed. But boy, Mr. McCants is right. When capital is expensive and time is cheap, magical things can happen.
I want to double click at something when you mentioned that venture wasn't necessarily the most obvious industry to be in. It's unlike now everyone's like, there are thousands of seed stage firms at this point, and capital is, I mean, like we're in a bear market at the time of this recording, and I don't imagine this recording to be out in a bull market. Maybe it does. I don't know. But I'm actually really, really curious because you mentioned something before while you're at Princeton. You made a trip to the West Coast. And please do set the record straight if I'm off here. But then you just showed up, and like according to the podcast, you showed up at the Princeton office, and you just said, you know what, I want to invest in private equity and venture capital. I want to own that portion of like what Princeton's been working on. How did that conversation go down? I imagine, like you mentioned, it was non-obvious. I don't imagine they just go like, Chris, here's a budget, go do whatever you want with it. There must have been some back and forth.
The thing that was crazy was I really wanted to get into endowment management. I had a horrible business school summer at Morgan Stanley. It was the summer of 2000, and investment banking is in itself just kind of soul sucking. And the summer of 2000 was a brutal summer because nothing was really going on, and Morgan Stanley had actually overhired because they'd assumed that all these people would go to startups, but they actually ended up, joining. So we had 50% more summer associates than we thought we would, and it was just this horrible summer. So I sat down with a friend of mine, Seth Alexander, who's now at the chief investment officer at MIT, and Seth and I talked about kind of what he did, and I said, look, I want to be a principal, not an agent. I want to, I want to. I want to think like you guys do. And Seth said this, he's then at the Yale investments office. He said, this is like the best job ever. It's the closest you'll ever come to managing your own multi-billion-dollar fortune. And so I said, hey, so are you guys hiring? And he said, no, we don't hire MBAs, but go talk to the Princeton guys. And he said, when you talk to them, talk about timber. And here's the reasons why timber is such a great endowment asset class. It's long dated. You can leave it in the ground if prices for the commodity aren't good, and it continues to grow and accrete value. So that was kind of awesome. And I went to Princeton and talked about that. And they wanted to hire me to be a real assets guy. And so I show up at Princo in June of 2001. And um, I'm just kind of getting my feet under me. And 2 weeks after I start, the guy who was doing venture, this principal, we had a managing director of private equity and then a principal that worked for him that did a lot of venture, and that guy quit. And so they were kind of like looking around at a Monday meeting and said, hey, who wants to do this venture thing? And it's like, the nose game where like, the not it nose game where everybody touches their nose and the last person who doesn't. And I ended up being the venture guy because it was like just is such a fallow period and nobody else wanted to do it. So I then went out to California, and there's this great line from Walt Whitman where he says, in California, I see the genius of the modern, the child of the real and the ideal. And even though there was, kind of frozen capital environment, and company formation was at kind of then historic lows, and people were moving out of the Bay Area in droves. I was just amazed by the things I saw. I say, in venture we get to live a few years in the future, and I was like, wow, this is really kind of Whitman's promise. He said, in California, I see populous cities and the latest inventions. And he was writing that in 1855. And here I was in 2001. I'm like, wow, that is just true. And for me, it was like really part of the idea of America. This kind of innovative streak, this iconoclastic streak, all of it was just so appealing and exciting to me. And I went back to Princeton. I was like, I got to do this forever. And here we are 23 years later, 22 years later.
I'm curious, you mentioned that tons of people were leaving California just now. And we're seeing similar episodes of that over the past like couple of years. What was the reason in '01 why people were leaving California?
you know Funding had dried up, and so the tech world and the innovation ecosystem more broadly is just so magnetic and draws um, the best and the brightest into its own vortex. And people have, by the way, proclaimed the death of Silicon Valley over and over and over, going back to the 80s. But I think the motto of Silicon Valley is get knocked down 6 times, get up 7. It's the same complaints we hear today. Cost of living was too high, there's better opportunities elsewhere, et cetera, et cetera. And I've actually often thought that we would see a rise of the rest, and I think that that's very healthy to the country. But on the other hand, it's been amazing over these 22 years of my career how resilient the major tech hubs have been. And so I think there's this like engorgement and disgorgement cycle that goes on in boom and bust times. And the history of California is very much the history of booms and busts, right? Yeah, going back to the gold rush, to the Dust Bowl, to the dot comers, and so even now, I think it's exciting and important for the country and the world that innovation gets more broadly distributed. But I also think that the money center for the innovation ecosystem is in the Bay Area, and will continue to be, just as Wall Street continues to be the money center for the public economy. Even though it existed originally because that's where the Erie Canal led to the Hudson River to disgorge kind of trade. That's kind of persisted for 200 years, and I think the Bay Area will for another couple of years. The other thing that I think that's also interesting about California specifically, and I don't mean to be too much of a homer here, but California is one of the few states, and I know there's legislation nationally, and some states keep trying to pass this, but it's one of the few states where non-competes are unenforceable. And I think that lends a great vitality and incredible energy, frictionality to the ecosystem, where all these kind of particles moving past each other create sparks.
So one of the one of the folks that I absolutely love in this world is this guy called Ravi Balani, and I'm lucky to work with Ravi at this point at Alchemist. And he said, and I'm paraphrasing here, that many of the best funds who can reach independent conviction are often based outside of hot neighborhoods. For example, not South Park in San Francisco, Sand Hill Road just south of it. And the reason for that it's easier to not be bought into the noise of herd mentality if you can't walk into a coffee shop and hear like a million things by osmosis, even when you don't intend to, right? And it also seems to corroborate with a part of the reason that you chose to invest in the house fund at Berkeley. And so for you, how important in your mind is it for a GP or an LP to have geographical presence?
Obviously, with what's gone on with the kind of COVID geographic shuffling and work from home, the world has changed a lot. Um, but I still am of the mindset that geography remains important. Ultimately, I believe it's the frictional encounters between people that create create unique sparks. And you look at one of the things that I think has historically been interesting about the Bay Area is somebody once said to me, entrepreneurship is like a gas, it's hottest when compressed. And you look at other kind of great innovation hubs like Israel, which has had an amazing innovation hub. It's there's just a lot of people in a little kind of spit of land that's actually not much bigger in size than if you compared it to the Bay Area, it would probably be Petaluma to San Jose. And so I think there's something to that. Now, I do think herd mentality is a problem, and it's a problem across um, all investing disciplines, right? Because the first rule of investing, according to Jeremy Grantham, is that most people uh, most people first consider career risk when making a decision, right? This is the old John Maynard Keynes line: it's better to fail conventionally than to succeed unconventionally in matters of reputation, right? So I've been very fortunate in my career that I've had people who have encouraged me to do things that are kind of iconoclastic, because if you worry about um, being wrong and alone, which creates career risk, you'll never be right and alone. And that's a very long and abstract answer to the question, which is actually like, sure, there is herd mentality, and people seek social proof, etc. But I actually think that that's true in any investing ecosystem that you go to. But what you don't have in sparser ecosystems is the richness of the interactions that you do in places that are more dense. And I'm not just talking about the Bay Area. I'm including Los Angeles and New York and Boston, and then in different verticals, maybe Miami, or even in things like healthcare, Indianapolis. Like, I'm a big believer in Michael Porter cluster theory.
And I also know you have a great story with Michael Porter as well, which, if we don't get into this episode, you've shared it a couple of times across other podcasts as well. So I highly recommend people to check and to like Chris content across the interwebs. Um, this is fascinating, and so I want to go back to something that might be thematically close, but I also want to fulfill a promise to our audience, which I said I was going to go back to the Princeton origin story, right? And let's place ourselves in the time that you're now taking on the venture capital and private equity portfolio. You're tackling this. As far as I know, you this is out of like B school. This is post like a summer in Morgan Stanley. Um, and the question here is, where do you build deal flow, right? Like, I assume you're starting from scratch, or unless someone else is handing you their Rolodex of contacts. Like, here's everyone to talk to when you're in the Bay Area, or like, here's everyone to talk to if you're investing in venture capital. How do you go around, one, building deal flow, and then two, exercising, like building those relations? It's a very much, we live in a very much like relationship driven business. So I'm going to pause there, but curious on that.
Yeah, so it's really interesting. I was in one way very lucky because I showed up at Princeton and had an incredible built-in network. But the reality is that Doug Leone wasn't talking to me because I was Chris. He was talking to me because I had a piece knitted on the chest of my sweater, right, metaphorically. But where I went with it, and this is actually something, in terms of the the folks who are listening to this podcast, a lot of people get into venture and follow one of two strategies. There's some people who, kind of pursue brand names, and that's, certainly a lot of institutional investors do that as well. And they're, brand names are brand names for a reason, but you also have to understand where people are on the arc of their firms, where they are personally, and where their firms are on their arcs of development. And the reality is, a lot of branded firms become asset managers and raise. Mike Maples famously says that your fund size is your strategy, and when you're deploying billions of dollars, it says a lot about the types of that alone has a lot of information, not only about the types of deals that you're doing, the chances of success for compounding that capital, the incentives that are available, and the increasing cleavage of incentives between the GPs and the LPs, etc. So brand is a strategy that some people pursue, but another strategy is just buying raw optionality, right? People just go and try to find, try to buy a bunch of lottery tickets, and that works as well for some people. For me, it was always important to have an opinion, right? And this is actually the bit of one bit of advice I'd give is like have an opinion, have a viewpoint. There's so many investors who are just kind of caught up in these tides of they're heat-seeking missiles, kind of looking for the new thing. The reality though is by the time the new thing is new to them, it's already kind of a little bit longer in the tooth in the ecosystem, and probably all the great kind of deals have been done. So for me, what I wanted to do is I wanted to get smart, and I wanted to have a worldview, and that worldview could have been conventional, but I didn't I also wanted to see where I can like look at the world a little bit orthogonally. And so Tim O'Reilly has this great from O'Reilly Media. uh, he was I was lucky enough to bump into him in like 2003 or 4, and somebody described him to me as the Obi-Wan Kenobi of the tech space. And I said to Tim, I said, how do you figure out like you have this publishing empire and your books are like on every developer's desk, like how do you figure out what's the new thing? And he says, look, we listen to the faint signals of the alpha geeks and we amplify them. And I thought that was really interesting. That really stuck with me. And I said, okay, so what faint signals am I picking up? Because, people are looking for brands or people are buying optionality. They're listening to very loud signals, but I wanted the quiet signal that might get amplified, that where I could like ride the wave as it was cresting. And rewind to that time, 2004, 2005, there really weren't a lot of small funds. And so I started spending time with Tim O'Reilly, Eric Ries, and these were like on visits I'd make from Princeton. And I said, look, I was tired of the way we were doing due diligence. We would run up and down Sand Hill Road and we'd say, hey, Doug Leone, who's good today? Hey, John Doerr, who's doing good work today? Hey, all these like luminaries. But what you're getting is like warmed over conventional wisdom that might even be a little bit politicized. Like Doug Leone once said to me, says, I hate doing references because I don't want to put my competitors in business. And so I started saying like, okay, so I started trying to find entrepreneurs because they're the like feedstock of our, information. A lot of LPs like talk to other LPs and GPs, but it's really the entrepreneurs who know what's going on. They're the primary source of the raw material. And so I started like talking to companies that, people that I'd read about in my, kind of college alumni mag, and you'd show up, kind of south of Market on a Friday afternoon with a a case of beer, and you talk to the three founders for an hour. And it was like a wild time because I started then, getting to know people, and these were like cold calls. Like that's what's amazing about Silicon Valley that's unique in my perspective. And I've done business in South Florida and on the East Coast and everywhere, but on the West Coast, there's a much more open social graph, and you're two phone calls away from anybody. And if you're credible and have an opinion, you can find yourself in front of some pretty remarkable people. And so that's when now fast forward to like 2003, early 2004. That's when I was finding out about people like Josh Kopelman at First Round and Mike Maples and the OATV guys and people doing really interesting work. And it was only because I was talking to these entrepreneurs who, they didn't know, they didn't know whether Sand Hill Road firm A or B was better. They just knew they were these big behemoths. But people who really understood their business were people like Josh Kopelman or Steve Anderson or Jeff Clavier.
What I'm really curious about is what is the anatomy of a good cold call like? Like how do you begin the call? How do you end the call? How long does it take? Like, can we break that down?
I don't know if anybody really calls anymore. So now it's emails and DMs and occasionally texts. But what I've found is uh, e- everything's like pulling on a string. I don't think I'm by any stretch an expert at this. What I am though is I can be persistent, and persistence is underrated because I think sometimes people meet with you just to get you off their back. So now I was lucky. I was extremely lucky because what I was bringing in every situation was capital, right? When I was at Princeton, we were potential investors, um, and then on to TIFF and beyond. I've always had a checkbook, which is nice. But what's nice is that if you help people, and one thing, a lot of people want an LP perspective, and because people are in their echo chambers, and if you can give them maybe a 30,000 foot perspective where you can give them a flavor for what other types of investors are doing, or give them insights into that, or what trends in capital raising might be, or feedback on a deck. I always think the energy you give out is the energy you get back. And if you do that and you build a track record of doing that, people will vouch for you. And then once people start vouching for you, that's the sky's the limit.
All right, I want to ask another anatomical piece. So we're going to have the physiology of Chris Douvos right now, or Chris Douvos's mind, which is, you mentioned there are different ways you can approach the world of venture. You can have that fund size as your strategy, brand as a strategy kind of thing, but you can also have, like, buying optionality, so to speak, right? And your approach is having an opinion. How do you go and start about having an opinion? You mentioned you talk to founders. Do you talk to any kind of founder, or is there like a localized, you talk to seed stage founders, series A founders, pre-seed founders? Like, how do you, what inputs do you put in to the algorithm to output an opinion?
So for me, I started, day one. I came out of the investing womb, as it were, with a bias, which was, I always wanted to invest with people who were investing pre-spreadsheet, right? Because what I saw was, as soon as you put a multiple on something, um, those rounds can get really competitive, and then the marginal dollar is always going to win, and the marginal dollar is the dollar with the lowest return. So I wanted people who really focused very early. Startups are inherently fragile. I started everything with a view that, how do you take the fragile and make it anti-fragile? And so for me, that became an exercise in trying to understand what about startups, um, made them more anti-fragile, as opposed to just kind of becoming, sexy zombies. That were going nowhere. And for me, and this is like a 3 or 4 year progression in the early 2000s. For me, what it came down to, and I'm, by the way, also slow on the uptake, so other people probably figured this out in a matter of days, if not weeks. But for me, it came down to culture. And so I started spending a lot of time with folks who had an entrepreneurial background, and really brought an entrepreneur's sense to the startup journey. And that was actually, today that's commonplace, but in 2002, three, that was extremely remote. Very, very few. There were relatively few entrepreneurs turned investors. When I was meeting with people who had operating roles, it was like a breath of fresh air. And I keep referring to Josh Kopelman and First Round, um, but that was a really formative experience for me. Meeting with Josh in 2004, spending time talking about his serial entrepreneurship and what he wanted to bring from that to the challenge of investing was really eye opening. And one of the things that I thought was really innovative was was that he said, "Look, we want to offer." Um, a venture firm as a product. Like, you know, a lot of venture firms say, like, our LPs are our customers. That's BS. I'm a shareholder. I'm not a customer. The customer is the person who consumes your service, and that's the entrepreneur. And so how could you create a suite of services? And First Round has spent the last 20 years, doing and perfecting that. And others have followed, in some cases very authentically and successfully, in other cases less authentically, and less successfully, but that's another story. But so that, like, led me, Josh said, look, with our suite of, kind of engagement with the entrepreneur, one thing we do is we help set the company's DNA at the earliest stages to maximize its chances of success. And then that led me to this belief that, like, okay, so how does a firm punch above itself? Like, how do you leverage an ecosystem, right? And First Round is creating an ecosystem, but, like, how do you, they were investing in the infrastructure to create an ecosystem, and they've been successful in creating, an ecosystem of scale and scope. But then how do you like tap into ecosystems and shortcut that process? And that's led me to some of the things that, I've done more recently, like the House Fund, where you're leveraging, a world-class, research institution in a very authentic and engaged way. And that, because there are a lot of people who think that, venture is this like dark art where some person like sits there, like some Fred Wilson-esque person says, I like this or I like that. And you know what? There are a handful of big brains like Fred in the world who can pull that off. But for me, it's investing is a much bigger challenge than any one person can pull off. You need it takes a village.
It really does, and there almost seems to be this revival in the venture world right now of like community based venture investors, where everyone's leveraging some element of community, and that might have just been like that ecosystem approach that Josh was thinking about at the very beginning. When you were chatting with Josh, if you can, we can rewind ourselves to a decade or so back. He was pitching this ecosystem. Did he have it already, or was it like purely a pitch? Did he bootstrap? Did he MVP it? Like, how did it look?
Yeah. So, I mean, let's rewind to 2004, right? Like this is 19 years ago. We're sitting there in the West Conshohocken Marriott right outside of Philly, and Josh had a vision, right? Um, and we always used to say we would eat at the Marriott, and we'd have breakfast there once a month or a couple of times a quarter, and we would sit there and we'd say, "Wow, this feels like Bucks East." Like Bucks is this famous, diner in Woodside, where a lot of venture stuff has gone on, and then we'd kind of laugh at ourselves because it was us and a bunch of like insurance executives on business trips. But Josh had a vision, and in 2004 and willingness to as first round always has said, to turn venture on its head. Like how could you disrupt venture? How could you be a venture entrepreneur? And he always said, let's turn venture on its head. And what he meant by that is like venture was then exclusively and still is today a lot a hub and spoke model where a lot goes through a lot of entrepreneur stuff goes through the partner. But he said, why don't we create a peer-to-peer network? Right? Why don't we remove the venture capitalists at the hub, and why don't we create ways for entrepreneurs to engage with each other? And I thought that was brilliant. And that's my like one claim to fame is I said to Josh in that moment, I said, look, what you're talking about you're not talking about portfolio, you're talking about community. And so when you walk into first round offices now, there's a sign that says portfolio and it's spray painted out, and then underneath it says community. And I think that that's really really important. There's great resources. Nobody has more empathy for the entrepreneur journey than other entrepreneurs. Nobody has more insight into that journey than entrepreneurs. And even as people transition in a venture, some of their insights get stale. It doesn't take long for that to get stale. So I've always appreciated that. And then what I saw in Josh was a willingness to invest not only money but time into building ahead of growth rather than in response to growth. And so the amount of that those guys were quite frankly out of pocket in terms of money, in terms of building out and investing in not only physical infrastructure like offices, um, but also kind of technological infrastructure and building an in-house Yelp and for service providers that startups use and doing all kinds of stuff like that. That took a lot of money back in the day, but more importantly, it took time and attention, and that's really the scarce resource.
Oh, I love that story. I've heard different permutations of that story, and the whole reason for the question itself is just like I want the full picture, and I think I got a much fuller picture with your answer just now. I want to take another case study. Per se, you were also a very early check, if not the first check, into Data Collective, which, correct me if I'm wrong, because there's only so much you can do in the world of researching. And but you put a $7.5 million check into a $77 million fund, and then you leveraged your LPs to add an additional $30 million fund, which altogether accounted for more than half the fund, which requires a lot of conviction. Like as I imagine, a pretty darn risky bet. how did you reach that conviction to put one, not only your own funds into it, but also leverage so much of your social capital to be like, this is the got to be the fund manager we back.
And in fairness, you're right about the numbers, although not all 30 came from my investors. Like most of that came from my investors, but we also brought a couple of friends along, like Beezer Clarkson, who had also found Data Collective independently. But we spent a lot of time, kind of tackling that opportunity. And look, for me, it was the conviction started. The had you at hello moment was I went to a data scientists meetup in San Francisco, and I have no business at a data scientists meetup, but you just go and you show up and you do your like golden retriever thing and you talk to people and find out things, and that was my like Herodotus, the great Greek historian. And so I was, whereas Herodotus would go from the land of the Lydians to the land of the Thracians to the land of whatever, I would go from the land of the data scientists to the land of the growth hackers to, whatever, and retell their stories. And so I was at this data scientist meetup and I'm talking to this guy who's like almost 7 feet tall and has this big bushy beard. It looks like Hagrid from the Harry Potter movies. He's wearing like a leather duster and an Iron Maiden t-shirt in my memory. He probably was a lot less foreboding in real life, but that's how I remember him. And he was a chief data scientist somewhere. And he had a PhD and from Carnegie Mellon and a PhD from Stanford, and big brain. And I said, hey, who do you think's doing some interesting investing nowadays? He said, oh, you need to get to know the guys at the Data Drinking Club, Matt Acco and Zach Bogue and those guys. They put together this thing at Founders Den every now and again, and they play cards, and we all love hanging out with them because they're really sharp and they understand us in a way that people like you don't. And I'm like, what does that mean, people like me? He goes, well, you finance guys, like you don't speak our language, but Matt speaks our language. And that was like the had you at hello moment. I said, once I heard that, I was like, wow, this person is an insider in something that like at the time, particularly, it was very esoteric. And I wanted to like spend time getting to know Matt and Zach and the rest of the team. And then from there, it was like understanding, what I always say is like, when I look at a fund manager, for me, uh, I'm looking for well-rounded wholes that are made up of jagged pieces that fit together nicely. When you have a team where everybody's replicating themselves, you're not getting, that might make for like a fun summer barbecue, but it does make for great, kind of discord and creative tension that drives you higher. And so I spent time with Matt and Zach and some of their other people in their like extended community, and I was like, wow, these guys actually have a really interesting setup where 1+1 might make 3, and they're worth, kind of one of my crazy bets of, I think that was 2011, and it's paid off really nice, right time, right place kind of thing. We've been really happy with DCVC, and I kept telling them every time I like was stressed out, I'd tell them, I've got a lot of reputation riding on you guys, and luckily it worked out. But
Hey, no pressure. I just want you to know that my career may disappear if you guys don't do well.
exactly, don't mess this up.
Oh my god, that's hilarious. Okay, I want to get more into like the nitty gritty. And this might be my last quote unquote serious question before we end off on a slightly more lighthearted tone. When we last caught up, and this is like over the blog post I was talking about, you wrote something for the emerging LP playbook, the non-obvious emerging LP playbook, that I found to be really, really interesting. So I'm going to read it here just because I don't want to like misrepresent your thoughts. But you said TVPI and IRR tend to be lagging indicators, not leading ones, for many reasons, including the irrelevance of these metrics earlier than 5 years, changing motivations, engagement, and so on for investors, and shift in fund size and strategy. And you also wrote in a 2013 blog post. Oh, I went back into Super LP and like
You
I
went
read
deep.
all of
Wow.
it. And you wrote, and I really like this analogous line. It said that the most meaningless number in sports is the score at the end of the first quarter of a football game. So much will happen before the final whistle blows that the first quarter score is a specious predictor at best. And so my question to you is, if it's not TVPI or IRR and it's too early to have Moolah in the Kula, which you so aptly named, which is like distributions to paid in capital, What are examples of leading indicators when you're evaluating at like a fund one manager or a fund two manager?
I think that when we invest, we're looking for people that have sustainable competitive advantage. There are people who, when you talk to LPs, most people will tell you they're looking for differentiation. But differentiation actually just tells you how different something is. It doesn't tell you how good it is per se. Things can actually be differentiated in how bad they are, or they can be differentiated in an area that's uninteresting. But what we're trying to do is marry the right people in the right place at the right time. And so for me it's kind of a four part evaluation. So first, I want to understand who the people are, what their unfair advantages, how they whether they have kind of a domain expertise or particularly rich network, or ability. This is particularly like challenging with fund ones because there's not a track record to sink your teeth into. So you have to end up looking at their corpus of activities to date. Were they um, a successful entrepreneur? But successful actually, sometimes people are successful. Nowhere else in the world do we conflate, luck and skill as much as we do in venture. So rather, I'd say impactful rather than successful. Were they an impactful, entrepreneur? Can they build tribes around themselves? Right. Like these are all things that I want to understand about the people and then as kind of a 1A, if that's one, what's their unfair advantage? 1A is like how do they gel, right? Like again, this question of every uh, great uh, team is a well-rounded whole made up of jagged pieces that fit together nicely. Do they have the right amount of kind of creative tension and ability to debate without hard feelings? Do they push each other's thinking and make themselves better? That's all important. Then part two is like understanding the strategy. And for me, like it's not necessarily because I don't have a monopoly on wisdom. And by the way, the people I'm investing in are a lot smarter than I am, and so I'm picking them to find the right space. Now, I have opinions about what are interesting spaces or not, but more importantly, I want to understand the resonance between the people and the strategy. Right? Are they the right people for the strategy at the right time? I used to give venture examples of this, but then somebody got offended, so I'll give a buyout world example. Sometimes you'll have these teams that that come out of like Procter and Gamble, and it's people who've been like managing brands, multi-billion-dollar brands, and they say, we're going to invest in kind of early emerging growth, consumer products, and we're killers because we all came out of P&G. But the reality is that the people that are running those products are, if they were at P&G, would report to the person who reported 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 to these people. And there's like such an attenuation of experience. And when you have a hammer, the whole world is a nail. And we see this all the time in venture. People want to kind of pursue things that they were successful at before that may not be the same things that they're doing. So out of that falls the portfolio, and a lot of people have kind of angel portfolios, which I tend to discount, quite frankly, because it's kind of to easier to get into those deals than it will be when you're pushing institutional weight. However, what's interesting about deals that people have done before is if there's some story, right? Everything that a fund is doing creates a mosaic that I'm like looking at, and whether there may be a lot of missing pieces. It might be like something you might see at Pompeii where there are a lot of missing pieces, but I can start to see the outlines of what that mosaic was trying to represent. And that's where I spend most of my time, is understanding that portfolio, because that's the people and the strategy in action. And when that tells you a story that's, I tend not to be a fan of eclectic stories. I tend to be more of a fan of thematic stories. That can be really exciting. And then out of that, over the long term, out of the portfolio will fall the performance. Because look, we've lived through a period where everything has been up and to the right. And so I don't know if you remember the movie The Incredibles, the Pixar movie, but man, like the bad guy was named Syndrome, right? And Syndrome, his mission, because one of the Incredibles had wronged him, his mission was to like, create a technology that made everybody incredible, because when everybody is incredible, nobody will be, right? And that's a real thing in venture. It's hard to look at these track records because everybody's been successful, everybody's line has gone up and to the right. But for me, what's much more interesting is understanding the portfolio and understanding why you chose those companies, why you were able to get into those companies, why you didn't get into the companies that you didn't get into, why you didn't choose the companies that you didn't choose, how you've been helpful to that entrepreneur, and even if you've written a small check, how that company is better off for having had your presence. And then very importantly, actually, that even I kind of skip over sometimes, is how you're thinking about portfolio construction. A lot of people, especially living through this period of power law, where people thought like, I'm just going to throw a bunch of darts up on the wall, and one of them is the next Uber that'll make my fund, 50 times over. But the reality is that I think the power law extreme, is now a relic of the past. We're not going to see companies go public at 40, $50 billion valuations. That'll be like once a decade kind of thing. I think we've that's a relic of the kind of zero interest rate um, world. Because, by the way, and sorry, I'm going to get on my soapbox for a second, because I always say I'm convinced they must not teach corporate finance at Stanford Graduate School of Business, because anybody who's ever you know analyzed a company for buy side public firm knows that you value the cash flows, for whatever your model period is, and then you assign a terminal value, and you discount that by whatever your discount rate is. And the reality is, a lot of the things that we fund in the zip code, when those companies go public, even then, the preponderance of value is going to be in the terminal value, and so your discount rate makes a big difference. And your discount rate is the risk free rate plus a risk premium. We've seen the risk free rate, as expressed in, kind of the Fed rate, move up considerably. 30-year bonds have moved up considerably. 10-year bonds have moved up considerably. So right there, like overnight, your value is slashed. Like, don't look at me perplexed with your cardinal red sweatshirt about like why your company is worth 40%, what it was worth, 6 months ago. It's all about the interest rates, dummy. And then, by the way, these things are now actually being priced as if they are, gasp, actually risky. So the discount rate is even that much higher. So don't be surprised that your $20 billion company is now a $5 billion company, which, by the way, is still an incredible amount of value accretion. It's not my fault that you raised $7 billion to get there.
That
Wow, off my
that
soapbox.
makes so much sense. No, that was incredible. There were some shots fired. It wasn't Russian roulette. It was like intentional shots fired. I love it though. I love these takes. And you're completely right. I think like at least in the portfolio construction, I'm not going to place myself anywhere in the category that you're in. I'm still a newbie at this, but I've seen some 50 odd like GP pitch decks since the beginning of this year, and one thing you notice is literally that one, everyone has great co-investors, right? Like there is no like fun deck that doesn't include the, you name it, like big top tier firm. I'm not going to name any names, but I'm going to be like the Doug Leone. I'm going to be like, you know what? I'm not going to give my like competitors a business. Never mind. But you see, everyone has great co-investors, and two, everyone's underwriting seemingly to this like this mythical unicorn exit, and it's becoming more mythical over time as well, especially in the economy in which we live. And the unicorn exit, obviously, you either IPO or you M&A kind of thing. And the world of M&A, if you actually look at like just who acquires unicorns, period, like yes, they might have the cash flow, but do they have the history of acquiring unicorns where you get a liquidity event? That's also far and few in between, depending on the industry in which you're in. There's great research on this, and I have a great friend who like spends a lot of time on PitchBook just literally looking and analyzing these things, but it's actually pretty sparse.
It's really remarkable.
So that was the shot put ball. That was not a softball at by any means, but thank you for the kind of the discourse that it inspired. I want to take a step back and then probably talk about some things that may be lighthearted, quick fire in nature, you love this kind of like methodology of wrong and alone, and you have this great 2 by 2 matrix of like wrong and right, and then on the other axis you have like alone and in the crowd, effectively, right? I'm so curious. There are tons of founders who are willing to be wrong and alone, and in fact, it's part of their business. If you want, like, I'm overgeneralizing, large returns, you
Yep.
have to be wrong and alone. In your mind, are there any, or like, do you have 1 to 2 currently in the past like 5 years or so GPs that you've chatted with that are willing to be wrong and alone?
A group that I get a really big kick out of is Rhapsody out of Boston, out of Cambridge.
Hmm.
And they really take an orthogonal view on the markets. First of all, they're doing material sciences, which are, kind of not sexy. Second of all, they engage in a lot of sweat equity investing. So they basically um, do a lot of tech transfer, for lack of a better word, um, and and then work with the professors whose research they're kind of spinning out and act as the business development team. They've got some resources. They've got a bunch of industry partners that they can work with to kind of help these companies do everything from kind of brainstorm markets to helping them manufacture the stuff to to kind of longer term partnerships. And what I love about them is that they say, look, our businesses, material science businesses, don't get bought for $1 billion, right? It just doesn't happen. The acquirers don't do it. And when these things go public, they get EBITDA multiples, not crazy tech multiples. And private equity buyers tend not to get super excited about overpaying for companies. And so they basically said, look, we have to capitalize ourselves right. This goes back to this portfolio construction question. So we have to assume that a company is going to get acquired for $200 million, right? $200 million. That's like a flashy B or C round, in these parts. But if that's your, kind of exit, right, that really impacts how you capitalize the companies. And they've done a great job of being able to invest and help the entrepreneurs and inventors build value. Um, Certainly they're early, and some dominoes still have to fall, but we're really excited what they have going on in a much more kind of hands-on space in the market than most people are used to.
I did say, or I did semi promise. So this may go on the cutting board, but we'll see where it goes. I was going to ask for impressions, and I
Actually, can I tell a story?
yes, tell a story.
This is actually one of my favorite stories. And I don't think I've ever actually told it on a podcast, but there used to be at Harvard Management Company a guy named Peter Dolan, who is a brilliant investor and a mentor of mine, and he's still active in venture. He works with McKenna Capital. But Dolan is like a real Boston guy. I think he's from Arlington, and he went to Harvard. And worked at Cambridge Associates, and I love Peter. And one of my first experiences in venture was meeting. It was an advisory board meeting of a fund that shall remain unnamed, and there we are. It's 2000 February of 2002, and the GPs are up there talking about their performance, and Peter says, "Hold on a second, you guys." Do you guys know that you drew $45 million in management fees last year and you only drew $10 million for investments? You know what that does? That creates J curve. And when I have J curve, you know what that means? My boss, Jack Meyer, this is the legendary Jack Meyer of Harvard Management Company, who is famous for paying people only relative to their benchmarks. Like you could get paid, it was always a scandal. Like people were getting paid $50 million a year for managing bonds at Harvard Management Company. But you could also get paid zero, right? Like it was all very quantitative. And so Dolan goes, so Jack pays me relative to benchmark. And what you guys are doing by drawing so much in fees and generating so much J curve is you're pulling down my whole portfolio. You know what happens when my whole portfolio gets pulled down? Jack doesn't pay me. You know what happens when Jack doesn't pay me? I can't buy my kids a bicycle. And when I can't buy my kids a bicycle, you know what they do? They complain to their mom. And when they complain to their mom, you know what happens? I don't get any loving. So because of you guys, I'm on a dry spell. And we were all shocked. And I don't know if, obviously, I think Peter was joking because he's like a hilarious guy. But I think his point was right. Like, I think a lot of GPs are very cavalier about, about the things that affect LPs, and understanding that things like J curve actually really matter to some people was really important. So the punchline to that story for me is like, I go around, I tell this story all the time at LP meetings, and have like the clutch of people like listening. Those who know Dolan would like really laugh because they could imagine like how exercised he was getting. And one day somebody comes around behind me and puts his arm around me and goes, Douvos, when you tell that story, you make me sound like Baby Bear from Sesame Street. And I go, Peter, oh my God. I'm sorry, dude. I'm sorry. So I love that guy. I learned a lot from that guy. And one of the biggest things I learned in that story as an example of it is like interest alignment is really important. We as LPs give, other people our money, and other people are investing our money in opium. OPM is like opium. It's a hell of a drug. And it's not just optionality that, if you lose it, it's gone. That those dollars like either, kind of support things like scholarships, or food banks or hospitals, or, even help, people kind of, pass wealth on to future generations, or whatever philanthropic things they want to be involved in. It's a very big burden for GPs, and one they should take a lot of responsibility for.
Well, Chris, that is as good of a note to end on as any. I love the story so much. I'm gonna be Peter's proponent and then go around like pitching that as well. This is so good. I had so much fun. I have a million more questions, but as all good conversations go, we run out of time before we run out of topics. Chris, I want to say a big thank you.
This is a great pleasure.
I had so much fun. I would love to have you on again. You might be a repeater on the pod, but I appreciate so much.
Always glad to do it. Thank you so much for the great questions.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are two completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for two reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist, and I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up, and as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, John, you're free to stay here for as long as you want. And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, you cannot manage what you don't measure. And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of, LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. Like, they're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and at the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.